Morning, everyone. Thanks for joining us today. Welcome to the Prophecy FY23 Results Investor Conference call. We've got everybody in listen-only mode at the moment. On the call today, we've got Prophecy CEO Brad Thomas. I'll pass you across in a moment to Brad to kick off our discussion of the company's FY23 results. We'll have a presentation from Brad today, followed by an opportunity for Q&A. If you would like to ask a question during the call, please type it into the Q&A panel within the Zoom app. So to kick things off, I'll hand over now to Prophecy CEO Brad Thomas. Go ahead, Brad.
Thanks, Tim. Hey, folks. Welcome to the call. I can see that people are still joining. Some familiar names and a few new ones, which is great. For those that are joining us for the first time, welcome and thanks for joining the call. And for those that are returning, great to see you again, and look forward to updating you on how we've gone over the last financial year. So I will work my way through the entire presentation because I just am aware that we've got some new folks on the call that may not have heard the story, but we'll try and go through. I think from a questions perspective, Tim, yep, if you can put your questions in the chat and we'll address those at the end. So let me kick off. If I can remember how to drive this thing. Right, okay, so who is Prophecy? We're one of the doyens of the Australian software industry and have been around for over 40 years. And we're a pure play B2B and B2G software and SaaS company based out of Adelaide in Australia. We're currently around 110 employees and we're operating in 2 locations in Australia. So Adelaide is the head office and Sydney is sales and some development. We have a big offshore team in Manila in the Philippines through our own subsidiary. We're not using a third party there. We have our own subsidiary company in Manila. And then our largest sales team is based out of Denver in the US, and we have some sales and product development folks in the UK as well. And across the business, we're selling into something like 60 countries around the world with both of our 2 products. But very much B2B, B2G, selling to medium and large corporates, government, military, and defence. So as a company, just a bit of background information. We finished the year with 19.6 million in revenue, and I'll talk about the numbers a little bit more. I think the market cap at 44.2 million at 60 cents a share is a lot less than it should be. We can probably talk about that more as we go forward as well. I think from a register perspective, I think roughly if you look at our register, about 1/3 is institutional investors, about 1/3 is insiders, and about 1/3 is retail. And those numbers fluctuate a little, but that's been pretty consistent for the last couple of years. And we have a pretty good representation of a number of the small cap funds, small cap tech funds in the Australian market, and a few internationals as well. So looking at a little bit of the performance of the business over the last 40 years, as I said, commenced in 79, 80 in Adelaide, developed a range of different software products over the years, and they went there through the normal life cycle of a software product, and as the technology changes, some of those products go away. We still have a few customers on some very old legacy products, and that revenue in the business was expected to run out in FY23, but we are going to get a little bit in FY24 as well. But primarily the 2 products that we take into the market are the Snare product, which is acquired through the Intersect Alliance acquisition in 2011. And then the eMite product, which is acquired when we acquired the eMite business in 2015. I joined in late 2016 and became CEO in 2017. And then, through the course of the last few years, we've been focused on growing the eMite and Snare businesses and really operating as a single entity, despite the fact they're actually separate subsidiaries with separate development R&D teams and separate sales teams. And we can talk more about that as we go forward as well. I think the thing that really interested me early on was the customers that we continue to work with globally, customers and partners. And on this slide, you can see, just a number of brands that we work with globally. we consistently signing, new enterprise companies and customers in Australia, in the US, and in Europe. And I think we consistently punch well above our weight when it comes to customer acquisition. I think, a couple of other things that are on this timeline worth pointing out. In 2021, we signed our largest SaaS customer with Humana, still a customer. We invoiced them the second year of their third-year contract back in February. Last year, we achieved record revenue of 16.4, and I've already mentioned we achieved 19.6 this year, so new record revenue in 23. And in 23, we were also invited to join Team Defence Australia with our Snare product. We've attended a number of conferences with them. We're very focused on the defence and military market. In fact, I'm heading to the UK next week for another defence conference in the UK, the DSEI conference. We attended one of those in Japan, a few months ago. We're attending one in the UK next week. And then I have a trade delegation with Austrade the week after that. So a busy time for us in that market segment. So let's talk about some highlights from FY23. Again, we continue to add, very substantial customers. I think one of the biggest wins in FY23 was our win with the ATO for eMite. That was a very significant multi-year contract providing eMite contact center analytics to the ATO. I think one of the other ones just towards the start of the new financial year was Macy's, another great global brand, one of the largest retailers in the US. And we do business with, folks like Verizon and BAE, Stellantis. If you don't know Stellantis, Stellantis is basically Peugeot and Renault and Chrysler and Ram and, a whole range of other car brands based out of Europe. And if you look at the spread of those customers, ATO is obviously Australian, Macy's in the US, LeasePlan is global out of the UK, Northrop and Verizon and BAE are all US based, although BAE is British, and we've done business with them in multiple countries. Stellantis is European. So we're signing up global enterprise accounts, in multiple countries on a consistent basis. And that has some good positive results. So eMite revenue growth, up from 7.6 million to 10.9 in 23. Invoicing increased 32% to 13 million. ARR growth of 22% up to 14.9 million. So eMite again continuing to move ahead on a pretty consistent basis with great growth. For Snare, the success has really come through that transition to subscription licensing. So 2 years ago, Snare was only sold as a perpetual license, and now it's sold as a subscription. And about 80% of our commercial customers, i.e. non-government, are choosing subscription these days. So we're building a very good base of recurring revenue with Snare. And that's been probably taken us by surprise how successful we've been with that. Government and military still tend to like perpetual, and we still have a few customers that we do pretty decent perpetual deals with because they've bought perpetual licensing from us in the past. And in fact, in the last month, we just did a $560,000 deal for Snare with Charles Schwab in the US. They're an existing customer of ours. And they've chosen a perpetual license because that's the way they bought from us in the past. But the vast majority of our non-government customers today are choosing subscription, which is fantastic. So obviously, two of the most important KPIs for us are the ARR, annual recurring revenue growth, and cash flow and cash in bank. ARR grew very nicely to 23.2 million across the business. That's across all products in FY23. And we had 11.8 million in cash at the end of the year. And that showed that we were, cash flow positive of about $2 million in the second half of the year, after spending a bit of money in the first half on, a number of growth initiatives. And some of those I'll talk about as we go through this presentation. Looking ahead, both the markets that we're working in, the cybersecurity, security analytics market, as well as the CX analytics space, with Snare and Emite respectively, are very healthy. They're multi-billion-dollar markets, growing at double-digit compound annual growth rates, and we have a very solid pipeline which we convert on a pretty consistent basis. So we're in a pretty healthy position going forward into FY24. So if we look at the actual numbers from last year, obviously the full financial results have been released, and so to summarize that again, record revenue up from 16.4 to 19.6, 26% ARR growth, growth in invoicing, probably a little bit down on what we wanted. We didn't get to invoice a couple of customers at the end of the year, which we'll invoice in this financial year, so they'll flow through into cash and revenue in 24, even though they were sold in 23. Overall negative cash flow for the year, $1 million in negative cash flow, but strong cash flow in the second half after investing some money in the first half. Strong cash balance, still well funded, no debt. We don't need capital. We don't need to raise, and we have an expectation that we should be cash flow positive for both the half and the full year this year. We are targeting growth again in the same kind of range that we experienced in 23. We expect to be able to achieve that through subscription growth in both Snare and Emite, as well as a couple of large customer wins that we're targeting on the Snare side. We'll talk more about the actual products and the market opportunity as we go forward, but we do expect to continue to grow revenue, to grow ARR, and to be cash flow positive in FY24. And if we can achieve all those things, then my goal is for us to be profitable at an EBITDA level across the combined businesses for FY24. So if I look at the products that we've got, they operate in very separate markets, and sometimes this can be a source of some confusion for folks when they're looking at our business. At their heart, they're both data products, and I will talk about the products in a little bit more detail as we go through the presentation. But basically, they are about collecting, analyzing, normalizing, correlating, reporting, alerting, and securing data. Emite in the contact center or the customer experience CX market space. Very exciting market, as we're now starting to see the adoption of cloud contact center and SaaS type applications for delivering CX really starting to accelerate. If you're a Jeffrey Moore, technology marketing leaping the chasm kind of follower, this is definitely getting past the early adopters into Main Street, where government is even moving towards these technologies, and the requirement to analyze data from multiple different applications and data sources is becoming more and more important. And we feel we have a very strong leadership position with Emite in that market segment, and we should be able to continue to grow that as that segment becomes bigger. On the Snare side, obviously the cybersecurity market globally is immense and continues to grow. We really fit in the security analytics market and the log management market. Both of those are multi-billion-dollar markets growing at double digits. And those markets, while they're heavily contested, are also heavily fragmented. So we feel we have a very good opportunity to continue to grow our market share. There are many players in this, and really only a couple of players at the very top of that market that have significant share. Most of the others are smaller like us, and we have an opportunity to continue to be successful in the market and to grow the Snare subscription base. So to give some more color on what the products do. So Emite is a CX analytics platform, so customer experience analytics. And we did do a live demo of both products, probably about a month ago. So if you haven't seen that yet, I think we had, about 60 people on that call. If you weren't on that call, I know that the The replay is available. I know it's definitely on the NWR website, and I think it's on the Prophecy website as well. Sorry, on the NWR YouTube channel, and on the Prophecy website as well. So please make sure you check that out. It's a great way to see the products actually working and to see what our customers see. But if you think about a customer who's got a contact center and is delivering sales and service to their end customers, whether it's B2B or B2G, what they're trying to do is to differentiate themselves through their customer service. And if you look at the typical environment that a customer might have, they'll have a thing like an IVR system, you know, press 1 for sales, press 2 for service. They'll have chat, they'll have chat bots, they'll have the contact center as a service solution. They'll have a CRM system, they'll have a ticketing system like a ServiceNow, they'll have a workforce management system, they'll have a transcription system, they'll have a customer sentiment analysis system, they'll have a survey system. So very quickly, we've got up to 10 different applications that they're using to deliver CX, customer experience, and they're all disconnected, and the data is in separate silos. And what eMight does, it enables customers to quickly collect all that data, join it together, because it's all disparate. You know, user ID might in one application might be username, in another application might be, you know, account name in another application, and we enable all that to be joined together and for customers to analyze their customers' journey throughout their systems and processes and people engagement with their business, and work out how to optimize their customer experience and customer success. So that's what eMight does. Obviously, you can visualize it, you can report on it, you can share reports and dashboards and visualizations, you can schedule reports, you can run alerts, you can put KPIs and calculations and algorithms and thresholds on all that data to make sure that your business is running the way that you want it to. And we have, you know, a number of fantastic customers globally. Talked about Humana, we talked about Macy's, we talked about the ATO, Services Australia, you know, Centrica in the UK, LeasePlan, 1-800-Flowers, Airbnb. You know, some of the largest companies in the world use eMight to run their contact center environment and their customer experience. And I think importantly in this market, you know, we took a look at the CX market space a few years ago, and it's still continuing to mature and emerge. And we thought, who are going to be the winners in this market space? And then we realized, well, we can't pick a winner. What we have to do is to be in a position where, regardless of whoever wins or what happens or which new entrants come in or what new applications become important to customers, we need to be able to integrate with those and talk to those quickly and meaningfully, and enable eMight to remove all the bottlenecks in collecting and analyzing data across the customer's environment, whether that's on-premise or their SaaS applications. So a few months ago, we launched iPaaS, Integration Platform as a Service, for eMight. You know, this is some of the things that we've been spending some of that money on over the last 12 months. And this really enables us to increase our effective addressable market in that CX ecosystem market segment. Today, we have relationships with Genesis and Amazon as the two largest players in the CCaaS market space. But what the iPaaS or iPaaS solution enables us to do is to go and talk to anything. So whether that's a Nice by Incontact, you know, CX1, or whether it's Five9, or whether it's Twilio, or it's TalkDesk, or any CCaaS platform, or any ticketing system, or any chat or chatbot, or any IVR system, or any workforce management system. And that massively increases our scope to chase opportunities, sales opportunities, right across the ecosystem. So it's a huge increase in our ability to address that market, and it is unique technology which we have effectively invented in this CX market space. There are a few other players that play in that integration platform as a service market space, but they are much more generic around BI, whereas we are very focused around customer experience, because we see the opportunity in this rapidly maturing and evolving market space. And we still see, you know, huge numbers of customers struggling with the cost and complexity of integrating systems and obtaining the the correct data for their end user customers. So this is super exciting and something that we'll be continuing to talk about in the market as we sign new customers using this technology. Snare, on the other hand, is a security analytics tool, and while eMight is going out collecting data from multiple systems and applications and contact center agents, Snare is collecting data from network endpoints, SaaS applications, in on-premise applications, servers, desktops, Linux devices, Windows devices, Unix devices, Mac devices, networking devices like switches, routers, hubs, basically anything in an IT environment, cloud-based systems like AWS or Azure or Oracle Cloud, anything that a company uses to deliver computing networking that needs to be secured. Snare collects log data from those systems and again normalizes it, correlates it, analyzes it, reports on it, alerts on it, and enables you to monitor exactly what's happening inside your computer environment. I always broadly talk about two kinds of solutions in cyber. There's the perimeter security designed to keep the bad guys out. But once the bad guys get in, and they will get in, then you need to be monitoring the environment to see what's going on, to be able to detect anomalous or behavior or potential compromises. And that's what Snare does. It starts to look at what's occurring inside your network and helping you determine whether that's normal behavior or abnormal behavior that should be investigated. The great thing about that market is there is a plethora of compliance requirements from a number of standards, whether it's the ISO security standard 27001, it's NIST standards, it's reporting requirements out of the SEC or for critical infrastructure security, whether it's existing regulatory regimes like PCI DSS or HIPAA or NERC. All of those have a requirement for system logging and monitoring and actively looking at those system logs. And Snare helps our customers achieve those compliance requirements quicker, faster, more affordably, and with less resource than anyone else in the market space. And that's why we continue to get some of the very largest companies in the world in those heavily regulated industries. Obviously, government, defense, and military is our home ground. That's where Snare was built from. But banking, finance, insurance, energy, oil, gas, utilities, retail, and health are where some of our biggest customers come from. And Snare is not just a single product, it's actually a suite of products. So there's the endpoint collection that we talked about, looking at all of those devices that are sitting in the network or cloud-based systems that are connected to the network. There's the enterprise tools that help you manage the fleet of Snare agents and manage security policy across your IT environment. There's the parsing that we talked about. Every device generates logs in a different format, and we parse those together so you can make sense of them. And then there's our hero product, which is Snare Central, which is where all the analytics happen, where we store and compress all that log data so you can meet your compliance requirements for storing that data. It's where all the alerting happens, where the forensics and analytics happen, where the reporting happens. And that's really the hero product. And we are selling that whole stack to our end customers and continuing to innovate on that product as well. There'll be new releases coming out this year. So the opportunity in Snare is really, we continue to focus on that defense and military segment. We have a pretty substantial opportunity in the UK government at the moment that we hope to be announcing within the next few months. We still continue to expand our channel footprint for Snare. We work with big system integrators, the Fujitsus and the Atoses. We also work with the telcos like Verizon and NTT. We have Optus here as a partner for both eMight and Snare in Australia. And it's those partners are where we're really focusing. We are moving towards a more indirect channel model with Snare. eMight today is 100% indirect, and I expect that Snare will become the same over the next year or two. We obviously trying to sell into our existing accounts. Many of those have just got one or two of our products, and we'd like to sell them more of those. And of course, the big opportunity for us to build a growing, sustainable business for Snare is continuing to push the subscription revenue, which has been very successful so far. So I think we're executing against all of these areas for Snare, particularly with establishing new partnerships with those partners that already have relationships with our target customer base in those regulated industries, government, defence and military. We haven't got a slide there for eMite, but I think the same thing is similar with eMite. We have relationships with Genesis and Amazon today, and we're expanding that footprint out to other major players in that market segment. But importantly, we're also working with both the telcos and system integrators and implementation partners for eMite. So again, if you take Australia as a microcosm of that, we've got relationships with Telstra and with Optus for eMite. We also have relationships with NTT. We're doing business with Spark in New Zealand. We've got Vodafone or One New Zealand, and NTT in New Zealand and in Singapore, people like Teletech for Amazon Connect. So it's those implementation partners that are also very important, because they have both the existing customer relationships and a sales organization that we're trying to leverage to get into more and new partners. So as we go forward, again, talking about increasing ARR as our number one focus, and doing that in a manner that is both cash flow positive and profitable. Making sure we continue to expand into the eMite, available and addressable market space, and grow ARR through additional partners, expanding our footprint of subscription business with Snare, again through those large system integrators and managed security service providers, and to do that in a way that generates positive cash flow and an EBITDA profit. So that's really our focus for FY24 and beyond. And to make sure that we're not burning cash, and we're continuing to build a very effective, sustainable business that is innovating around software technology and generating sustainable returns in the long term for our shareholders and our customers. So to finish up from a presentation perspective, why is Prophecy a good deal? I think the tech segment has been particularly hard hit, particularly the small cap segment, in the last couple of years from a market sentiment perspective. At some point, that's going to turn around. I think Prophecy has a very solid, sustainable business that is growing at a good rate. I think we can continue to do that. As I've talked about, we have a couple of diverse revenue streams in very substantial addressable markets. We have very achievable goals around accelerating growth and increasing both our capacity and coverage, as well as new revenue streams from additional functionality from our existing product portfolio. I think the proof is in the pudding when it comes to the customers that we continue to be able to acquire on an ongoing basis. Every quarter we're announcing global blue chip companies coming on board with one of our products or the other, and we're at a point now where we are starting to achieve scalable growth, and we do expect to see margin expansion and profitability start to flow into the business. We have made some investments in people in the last year. We did spend some money in the first half in FY23, and as a result, we weren't cash flow positive at the half, but we generated 2 million in cash in the second half, and we expect to be in that position going forward from here. And I think both products are recognized globally across a very broad customer base to have very substantial value in the segments that we operate. So I think that's me from a presentation perspective, Tim, and it looks like there's a number of questions starting to roll in.
Yep, absolutely. Thanks for the presentation, Brad, and thanks to our attendees for all of your questions. There's plenty rolling in, so let's hop straight in. Before we get into the two lead products, there's one question regarding legacy revenue, which I think maybe we'll cover that now. So the point's made here that legacy income in FY23 was 600 grand. You did mention earlier, Brad, that that's expected to stop. The question is, will that disappear, or do you expect that to be convertible into revenue for EMITE or Snare?
No, this is a completely different offering that has no path to either Snare or EMITE. And effectively it's one customer in South Australia who is migrating off a very old technology platform, which is that legacy software. And honestly, I expected it to be gone by December last year. It's carried on. We'll get probably a few $100,000 out of it in FY24, but it should be completely done by Christmas, and I don't expect to see that into the second half.
Yep.
So
no
there's no opportunity for Snare or EMITE.
Yep.
From a migration perspective.
All good. So looking to the Snare side of the business, one attendee is asking if we're still in the running for the large US government contracts that you've referenced previously.
Yeah, we were initially in 9 bids. Of those 9 bids, 1 has been withdrawn, 1 has been awarded to a consortium that we were not a part of. So 7 are still open, but have not been awarded. So at this point, again, they don't appear in my pipeline numbers. If and when we're successful with any of those large bids, then that'll be additional to what's seen in the pipeline. We do have some other large opportunities, perhaps not to that scale, across defence and military in both the UK and in the US. And I expect to make some announcements about that over the course of the next 6 months. But yes, those opportunities are still live. Are we actively pursuing them? No, because we're not leading those consortia. They're run by other specialised defence partners, and quite honestly, they will happen when they happen. That's completely outside of our control. They'll either be awarded and we'll be successful, or they'll be awarded and we're unsuccessful, or they'll be withdrawn. But that's completely out of our control.
Yep, that's the game. All good. So just going to the product now, another attendees just referenced the deal that you've mentioned with Charles Schwab. Are you able to elaborate on the value and the potential of that deal?
Well, that deal was just on 560,000 Aussie. There was a perpetual license deal. That was Schwab acquired another business about 18 months ago, and we've extended our coverage of the Snare business from monitoring the Schwab environment to monitoring that plus the new acquisition. It's something like 19,000 endpoints being monitored by Snare. So typically large financial institutions have a range of compliance mandates that they need to meet, and Snare helps them meet those more easily and with less resource than anyone else in the market. So when you want something to just work, Snare just works. Yep.
Sounds good. So just a few questions just for the business as a whole. On the expense front, the point's made here that FY23 only saw a little bit of an increase in headcount from 109 to 111, but there was 20% increase in people, being employee expenses and professional fees. So the question is, what drove that 20% increase? I think maybe we start with that question.
As always, it's multifaceted, right? There's a range of things. Yes, a number of things happened. So from a P&L expense statement, some of the external consulting became employee cost last year with us taking the Manila team in-house. We also brought some additional external consultants on to help with the acceleration of the iPass development process. We've also swapped out a number of resources across the globe. People that we may have hired at one rate and now hiring at the new rates in the market. Certainly in the last 18 months, the war for talent has been incredibly hot. It was probably at its hottest maybe 12 months ago, but it hasn't really settled back from a pricing perspective. So getting good people is still very, very expensive, particularly in the technology segment. So yeah, well, there's been a range of things that we've done. Some of those will stop as we stop using external consultants, and we're moving some of that more into our own R&D teams. But I also expect that it's not going to get any cheaper to hire people in the technology space, whether they're developers, support people, marketing, or sales. There is still a global war for talent. We're hiring people in Australia, in Manila, in the US, and in the UK, and it's the same everywhere. So, we have a very clear picture of, what the employment markets are like in multiple different countries and geographies, and it's hard everywhere. Hard to find good people when they're not cheap.
Yeah. And so to expand on that a little bit, Brad, since we've had a few questions on operating expenses and operating leverage, do you expect expenses in FY24 to be flat, or sort of, do we see our OPEX growth back in the mid to low teens level in FY23?
Yeah, look, I would love to be able to hold everything at flat, but every single one of our suppliers are putting up prices where they can. We're doing the same. We're trying to increase by CPI or better everywhere we can. We're trying to upsell every customer. So I expect there to be some increase, but I don't expect it to be significant. We're trying to hold our expenses as flat as possible in FY24, because we are focused on growing and delivering both the top line ARR and revenue, but also delivering an EBITDA profit this year.
Yep, that makes sense. And so, would you expect headcount at similar levels, or potential for that to?
I'm happy with the headcount at the moment. I think I'm more interested in upgrades rather than additions right now. So I think we're trying to make sure that every single person we've got in the business is delivering a positive result for the business, or the result that we need for the business. So I don't see a lot of increases in headcount. If there might be a couple of sales roles that we bring on as we address different opportunities we have in the marketplace. But I don't see a substantial increase in headcount.
Yep. And so looking elsewhere in the expense lines, one attendee looked into the other expenses line and is asking about software expenses. And the question is, do we view that as a variable expense, or do we keep that? Do we expect to keep that relatively flat as a percentage of revenue?
So there's two lines there. So there's the cost of goods, which falls primarily today into the eMite business, which is the cost of hosting that solution for our end customers. And we use both Oracle Cloud and AWS as our hosting platforms globally. And as we bring on customers and bigger customers that require more computing power, then I expect that to grow in line with revenue. And I think what we're looking at from a gross margin perspective on the eMite side, because I see a question on that in the chat as well. That's currently running at about 85% gross margin. About 15% of the revenue is eaten up as hosting costs for eMite. And it varies customer to customer depending on what they need us to do. But overall, that's about where that is. Yep. And then we have, one of the other things we did in 23 is we brought all of our in-house computing. We had our own data center with our own hardware. We moved that to the cloud as well. So, there is an increase in operational costs from moving that in-house IT capability to the cloud. That's gone from a CapEx to an OPEX cost. And that's given us a lot more operating flexibility and increased performance and compute power and access to resources that we simply never would have been able to afford as a small business from a CapEx perspective. But that has hit the expense line in 23, and that should be consistent in 24.
Yeah,
but I don't expect again massive increases as we either add more customers or build more in-house capability on products. There may be some incremental expenditure in that area, but I don't see a huge increase. The cost of goods should increase in line with revenue. We are doing some things around re-architecting away from some technologies that incur pretty big licensing expenses, where we hope over the next 12 months to get some additional savings in hosting. But that will occur as and when it occurs. So if we expect that to stay in line with revenue, then that's where that should be for the year.
Yep, gotcha. Thanks, Brad. Yeah, so to round out that question on margins, I think you pointed out the EMITE gross margins there, but gross margins on the snare side, how are they?
Well, on the snare side, snare today is sold as a software appliance as opposed to a SaaS solution. So our customers deploy snare either in their own IT environment or in their own cloud environment. We don't host that for our customers. We provide it, as a deployable software appliance. So there is really no hosting costs for us on that. Really, the only cost of goods is us paying commissions to our salespeople. So and we don't include that in cost of goods calculations today. So it's effectively a 100% margin business, and everything that we sell over and above our baseline expenditure should flow through directly to the bottom line.
Gotcha. Thank you. And so, yeah, the same investor is just asking about the competitive advantages of both businesses overall. And can you point out who a few of the main competitors are that you're up against?
Yeah, on the snare side, as I said, there are many. But and I think I've said this before, if you look at that security analytics, log management market space as a Venn diagram, it would be hundreds of partially overlapping small circles. None of us do exactly what the others do, but the people that we will often see in the market are companies like Sumo Logic or Logarithm, SolarWinds, NXLog, Loggly. There's a range of players in this market from both Europe, Israel, and the US. So there are a number of competitors in that space. I think one of our competitive advantages is the fact that we were designed by ex-defense and military personnel for defense and military purposes, and our ability to operate in completely air-gapped and top-secret networks, including on a completely air-gapped network, which may be a plane or a ship or some other device, does make us different to many of our SaaS competitors or traditional software vendor competitors in that market space. I think the opportunity with Snare is to extend our capability into a SaaS solution, not to replace what we've got, but to complement it and extend it. So that's something that we're looking at. But Snare is the lowest touch, most comprehensive log management platform in the world, and I think one of the things that makes it very attractive to our customers is that you do not need a huge number of highly specialized resources to deploy, maintain, or tune on an ongoing basis the Snare platform, and it is all managed centrally, and it makes it very easy for our customers to deploy and manage and to meet their compliance mandates using Snare. EMITE's a bit different. That's a much more immature market segment, and I think we have a real leadership position in that market, particularly with the ecosystems that we play in with Amazon and Genesis. But we expect that we'll expand that leadership position more broadly this year to the rest of the market. And we really don't have a significant competitor that I can point to. There are other reporting and analytics players in those ecosystems, but typically the way a decision will go for a customer is they might move from a legacy on-premise to a cloud contact center system. They will look at the reporting of that contact center as a service provider. They'll realize it's not up to the complex and sophisticated requirements that they actually have. They then might turn to their internal BI team, who then also don't understand that contact center environment, what the data looks like, how they're going to get it, the complexity of the API integrations that they need to build. So they come looking for the proven provider in that market, and that's in most cases that tends to be us. We're very focused at the mid to large enterprise customer segment, 500 contact center seats and above. And as soon as you start to get to that level of specialized requirement in CX at that scale with that complexity, I haven't really come across anyone that can do what we do, and particularly with the release of the integration platform as a service, there's certainly no one in that market segment doing that today. So we're a bit unique in that regard.
Yeah, it's a good way to be. So I'm just looking through the cash flow statement. Pointed out that after a great second half of the financial year, the company missed being cash flow positive for the full year. Any thoughts on the drive towards cash flow positivity and potential timing thereof?
Well, I think I've already covered that. We do aim to be cash flow positive for the half and the year this in FY24. I would have liked to have made that in 23, but quite honestly, spending $1 million to launch a product like we have in and get the business into a position that we have in the last 12 months, I'm relatively happy with. 2 years ago, the market was telling me to spend money faster to grow faster. It's funny how things change in a couple of years, and now all anyone's talking about is cash flow and EBITDA profit, but that's just the way the market goes. Yeah, our aspiration and our goal and our plan to be cash flow positive for the half of the full year and to deliver a small EBITDA profit for FY24.
Yep, sounds good. So yeah, looking to FY24, the comments made that the pipeline looks smaller than how it did at this time last year. Given that, can you talk to your confidence of growing annualized recurring revenue at similar or greater levels in the year ahead?
Yeah, look, I think the pipeline is a factor of demand generation and sales activity. There are very few small cap tech businesses that have got customers banging on the door to buy their stuff, and we're the same. You've still got to go and sell it. It doesn't sell itself. So we have to work with our partners. We have to run marketing campaigns. We have to do industry events to generate opportunities and pipeline. And that's really the current pipeline. It's about the same as what we put up last year, and that's pretty consistent because we generate it and convert it at a pretty similar rate with the resources that we've got. And we're always looking to expand that, and our strategy to expand our partner relationships is really the way for us to generate additional opportunity without necessarily expanding the internal resources needed to go and do that in numbers. So that's what the partner strategy is really about: leverage. It's about generating more opportunity and getting more customers without having to hire a bunch more people. So that's what we're doing. So I'm always looking for more. I want more pipeline, I want more revenue, I want more cash, and I want more profit. So more is always better, but I'm pretty happy with the overall quantum of those things at the moment, and we'll continue to look at ways to accelerate that and enhance both our pipeline generation through those sales and marketing activities and also our conversion rates.
Good stuff. Thanks, Brad. Just coming to our last couple of questions now. So if any attendees have more, please pop them into the chat and we'll address them that way. So yeah, flowing from your last question, the questions asked about your aspirational revenue targets over the next few years. The questions asked of sort of 50 million, 70 million. We're all looking to sort of dream big here. So what can you tell us on that front, Brad?
Tim, I've always said world domination is the aspiration for the business, and that hasn't changed. And I think, look, if we can continue to grow at the same kind of rate over the next 3 years, then make some assumptions and do some simple calculations, and you get us to around about a $50 million revenue business in 3 years. It's 25 plus in 24, 35 in 25, and 50 in 26. And that's really without necessarily accelerating or making too many additional investments in in scaling, sales and marketing activity over the next 3 years. So I think 50 million is realistic if we can continue the same kind of trajectory. But I revert back to my more is always better comment of a few minutes ago. If I can do more and we can expand more in a way that makes financial, business and commercial sense, then that's what we'll do. But we're definitely looking to continue to grow the business at the same kind of rates we have done for the last couple of years and expand on the positions that we've built.
Excellent. Thanks, Brad. And last question we've had come in for the moment is just about our reporting plans. So will you continue to publish business updates quarterly to keep investors informed of your progress on annualized recurring revenue and income?
Yeah, that's the plan. We've been working with Tim and NWR for a bit now. It's been an incredibly busy year, but I think we've managed to put out reports, maybe a little bit late on a quarter sometimes. But look, we've got the statutory reporting requirements around the half and the full year, and our plan is to continue to deliver quarterly updates as well. So you should look forward to that from us.
Good stuff. And another question's just come in. So Prophecy trading at less than 2 times ARR. Why do you think the business trades at such a significant discount even to other small cap tech peers?
Yeah, look, we've had this. I did a number of presentations to institutional investors on last week, one-on-ones, and we did a few lunchtime briefings as well. And I think we do have some challenges as an organisation. I think the fact that Prophecy has been around for 40 years, and there's still a number of people that think they know what Prophecy is, it probably counts against us. I think that we have two very separate and dissimilar products in market. I think some people fail to understand that they are different, but they are both at their heart data products. And as a business, we understand data and managing data and data integration and data analysis. And while the domains are different, some of the understanding of how to manipulate data is the same. And I think the last thing is, we do only have 75 million shares available on the market. So I think liquidity can be an issue particularly for some institutionals. But generally, I think that we are trading at a significant discount. I think we represent very good value. Do your own research. But my job is to continue to execute, to continue to grow revenue, ARR, to generate cash and profit. And if we continue to do that, then at some point, the market will realize that we have a very successful, scalable, growing business, and we'll get re-rated accordingly. So, that's my goal.
Excellent. Sounds good, Brad. Well, thanks very much, everyone, for joining us. We really appreciate you tuning in today and for your continued interest in and support of Prophecy. If anyone's got a question we didn't answer today, please reach out. Brad and his team will be happy to discuss further offline. And we will also make the video recording of this session available online. We look forward to the opportunity to talk to you all again. And Brad, I might pass back to you now for any closing comments.
Just again, thanks to everyone for attending. Thank you for taking an interest in the business. I think we're building a very interesting and sustainable business that's set up for long-term growth here. So thank you for taking an interest, and please look forward to more updates from us over the next months.
Good stuff. Thanks, Brad. Thanks, everyone. Chat to you later.
Thanks, Tim.